Hi, my name is Jordan Wilson. Today we continue our look at the buy and hold investment strategy. Now, for me, an issue with buy and hold, not a valid criticism, but something that actually happens, is that investors sometimes equate hold with hold forever. And while they're quite closely related, I don't think you can buy and hold forever any individual stocks, bonds, non diversified assets. And even with well diversified investment products, mutual funds, ETFs, you still need to do some periodic reviews to make sure that they are best in class, that circumstances haven't changed. So it's buy and hold, but not necessarily buy and hold forever. And then what I often see with some investors is they even take it one step farther and it becomes buy and forget. I buy my shares of Coca-Cola, I buy my shares of Amazon. I take the share cert, throw it in my safety deposit box, and I forget about it until retirement time. And I think we've seen too many examples of individual stocks. Eastman Kodak springs to mind, Blockbuster Video, Enron, Nortel, WorldCom. So many companies out there that were seen as fantastic stocks, but over time the world changed and they no longer became strong investments. And when we look at the current crop, the Teslas, the Facebooks, the Netflixes, the even Google or Amazon, how long have they actually been around and been dominant? For many of these companies, Facebook and Tesla spring to mind, around a decade they've been public companies. So they don't have that long track record that would put the warmth in my heart that I could buy them and throw them in a safety deposit box someplace. So buy and hold, yes. Buy and hold forever, yeah. Maybe with well-diversified index funds. And definitely not buy and forget. So that's what we want to start talking about today is the portfolio review process. And this will just be kind of an intro because as we move forward, we're going to get into benchmarks, reviews, how to rebalance when things get out of whack. The first item that sort of triggers a review or frequency of review is the overall portfolio risk. The higher the portfolio risk, probably the more frequently you should review the portfolio. And I think risk we've covered ad nauseum, but it's partially the asset risk, so the risk of that specific investment, but also your overall portfolio, how well it's diversified, the asset correlations, that dictates the risk. So the lower the risk portfolio and the better the diversification, the less that you need to review. And I kind of use a benchmark of an annual review for most people. And if it's a low risk portfolio, a less strenuous review. Higher risk portfolio, more strenuous. But I mean, technically, if you are the proverbial widow or orphan and you have all your money tied up in a 5-year term deposit at your bank or a 5-year government bond that's AAA rated, maybe if that's your only investment, you don't need to look at it because you're just going to hold it to maturity. So a 5-year review could be warranted. Not necessarily what I would suggest, but from a technical view. At the other extreme, maybe all you're doing is trading 90-day stock options. You can't wait 5 years in that case to review your portfolio because it's very volatile. Maybe it's on a weekly basis or daily basis that you need to assess where you are as far as the strike price and the market price. So the greater the volatility or the risk of a portfolio, the greater the frequency of the review process. The second aspect I think that kicks in is the overall general market or economic volatility. And here I'm not talking about the stock market, I'm just talking about the world in general. If you recall our risk discussions, risk is broken down into two forms. One of them is the systematic risk, and that's the rising tide lifts all boats. You have the economic risks, inflation, interest rates, currency. If I run a company or I'm renewing a home mortgage and interest rates, because of inflation, have gone from prime of 2.5% to 4.5%, that's going to impact my business, my home mortgage, my cash flow. And yes, the better credit rated individuals or companies will be penalized less, but they'll still be penalized. You can't really protect yourself against systematic global risks. If we look at other systematic risks, we have the the geopolitical risks, natural disasters. If I am running a business in Venezuela over the last decade, huge issues there. I can't just say, I'm going to buy and hold forever. That's what I was told. The world has changed, at least in Venezuela. Periodically, we see this in the Middle East. Tensions rise and fall. Hong Kong, what we've seen going through the last year plus. That's changed, probably a permanent change. You can't operate in the same way. If I live in Florida and a hurricane comes through and destroys everything, you have to factor that in. So when you're in situations where there's greater systematic risks, then you probably want to review your portfolio, or at least the assets that are potentially impacted, on a more frequent basis. The next item that you look at is more on a personal level, and that's the investor or your personality. So I think that just by human nature, some people are more risk tolerant, some are more risk averse. If you are risk averse, you're likely going to want to do more frequent reviews. So if you're chomping at the bit and you're concerned about how your bond fund's doing, even though it's perhaps relatively low risk, just your personality will dictate that you're not going to sit around for a year before you review that portfolio. You'll want to look at it maybe quarterly, maybe monthly. Other people, I bought it, I own it, I'll worry about it down the road when I need to consider selling it. Again, human nature. Similarly, some people are more detail-oriented than others. And again, that's going to reflect in how they monitor portfolios. They've got their spreadsheets, they got everything input, they're following their return on capital, they're following their dividend yields. That's who they are. So if you tell them to do an annual review or a biannual review, that just doesn't fit in with their personality. So that's going to impact how often you review your portfolio. And then the final thing I want to cover just on review frequency. Are there material changes in your life or the investment itself? So a material event is anything that alters your life significantly, your decision making. You're cruising along, you're single, you're enjoying life, you get married. That changes how you operate. Probably changes your cash flow, changes your personal situation. You have a baby, same thing. Life insurance becomes interesting. You experience job loss, and we're in a recession, so there's no job possibilities on the horizon. That's going to change how you view your portfolio. You have an accident, you get promoted at work with a raise. Again, these impact. And this is why, if you recall, when we looked at investor profiles, who you are as an investor, which factors in all these things, directly drives your target asset allocation. So when a material change occurs in your life, you probably want to take a step back and say, how does this impact my investment portfolio? The asset allocation, my objectives, my time horizons, all of these things. And then on an individual basis, you have the non-systematic risks. And the non-systematic risks are those asset-specific risks. And this is less of an issue if you're in a well-diversified investment fund with 300 different stocks spread across many industries and countries. But the stock-specific risks do come in play to some extent with a less diversified fund, and definitely come in play if you're buying Amazon, Google, or Facebook stocks. So the non-systematic risks that you might face or might cause you to do a portfolio review is, if we look at Google, for example, I think in the EU at the moment and in France, they're being sued for their business practices. If that looks like it's not going to go well for them, you don't want to wait and say, it's now July 2021. I just did my annual review 2 months ago. I'm not going to do it for another 10 months. No problem. You probably cannot wait on those sort of things. You find out that a company you own, its patent that makes them unique is expiring. Or there's a new competitor with a new patent and new product that's challenging their dominance. Can you wait a year to review that? Probably not. We saw that in one of my favorite examples with Eastman Kodak. They joined the Dow in 1930. In sort of the 70s, they were the Apple with 85 to 90% market share in cameras and film. But then people decided that there's better ways to take pictures and not go down and drop off your 24 exposure rolls at the local drugstore for processing. We can use digital cameras. We can use our iPhones, our Galaxies. And by 2004, Kodak was off the Dow, and by 2012, they'd filed for bankruptcy. So new competitors, new patents, new products. Another favorite of mine is Blockbuster. They used to be everywhere. And then along came Netflix. Blockbuster became no more. So when you take on stock specific or asset specific risks, these non-systematic risks, you have to pay attention at a closer level than if you're in a well-diversified portfolio. So I think there's different factors in play as to how often you want to review your portfolio. Some are your personality. Some are how you've created your portfolio, individual assets versus well-diversified investment products. And some is just general economic and world conditions. If we see what's going on again in Hong Kong, how you operate there is going to be different than you did 10 years ago. Much different. So when the world changes, you have to adapt, and you have to review, and you have to keep ahead of the curve. That doesn't mean you're going to sell all your products, but you need to monitor and review. Now going forward, we're going to get into the portfolio benchmarking, how to create benchmarks, how to review portfolios, what should you be your comparatives, and then should you rebalance your portfolio? And that would mean should you no longer buy and hold, but have to divest something. So we'll get into all that as we move forward. But just some thoughts for today on it's buy and hold, yes, but still buy and hold, but review. Thank you very much for your time today. Have yourself a good one.